Let's get straight to it. What happened in October 2025 wasn't just another blip on the crypto radar. This wasn't your typical crypto dip, the kind seasoned investors shrug off as part of the game. This was something far more sinister and far more calculated. Bitcoin's crash in October 2025 wasn't just random volatility or a wave of investor panic. It was a moment that sent shockwaves through the entire financial world, and for good reason. This was a calculated, targeted attack on the very core of the crypto market's infrastructure. It wasn't just a matter of bad luck or poor timing. It was a deliberate strike, executed with precision. Imagine a building collapse blamed on wind, only to discover explosives were set on the support beam. That's what happened here. The surface explanation didn't match the reality beneath. Billions were wiped out in a matter of hours, not by accident, but by design. The losses weren't just numbers on a screen. They represented shattered trust, broken dreams, and livelihoods upended. Someone, somewhere, exploited deep flaws in the crypto ecosystem for massive personal gain. This wasn't a lone wolf or a lucky guess. It was a sophisticated operation, months or even years in the making. The story you heard about market jitters is a smokescreen, a convenient cover for what really happened. The truth is far more unsettling. The safeguards you trust? They're paper-thin, easily bypassed by those who know where to look. The systems we rely on to keep our assets safe were exposed as fragile and vulnerable. This wasn't just a bad day for traders. It was a wake-up call for everyone involved in crypto, from casual investors to industry veterans. The industry's foundations were shaken to their core, and most people missed the explosion entirely. The warning signs were there, but few were paying attention. Forget the headlines and the official statements. If we want to understand what really happened, we need to follow the digital breadcrumbs, trace the money, the code, and the motives. This is a story of a sophisticated attack, catastrophic failures at every level, and a shadowy figure orchestrating one of the biggest heists in financial history. The scale and ambition of this operation are almost unprecedented. The crash wasn't a dip, it was a deliberate push off a cliff, engineered to cause maximum damage and confusion. If we don't take the time to understand how it happened and who was behind it, we're doomed to see it happen again, maybe even on a bigger scale. The warning shot has been fired. The question is, were you listening, and are you ready for what comes next? Let's talk about the scale of the carnage. What happened on this day wasn't just another dip or a routine correction. It was a seismic event that sent shockwaves through the entire financial world. The numbers are almost hard to believe, but the impact was very real. On October 10th, the crypto market plunged into its largest liquidation event ever recorded. In a matter of hours, panic and confusion swept across trading floors and living rooms alike as prices tumbled with unprecedented speed. $19.3 billion in leveraged positions vanished almost instantly. That's not just a number, it's the life savings, hopes, and dreams of thousands of investors, wiped out in the blink of an eye. Over 200,000 traders, regular people, not just Wall Street pros, were wiped out. Some watched helplessly as their accounts were liquidated, while others frantically tried to salvage what little they could. Bitcoin crashed below $110,000, dragging the entire market into chaos. The world's most recognized cryptocurrency became a symbol of the turmoil, as its value plummeted and confidence evaporated. Ethereum lost 10%, XRP dropped 17% in a week. This was a bloodbath, not a correction. Altcoins across the board followed suit, with red numbers dominating every chart and portfolio. The market's confidence, built over months of steady growth and optimism, shattered overnight. Investors who once felt invincible were suddenly questioning everything. But here's the twist. This wasn't a uniform sell-off. Not every platform experienced the same chaos at the same time, and not every asset was hit equally. Data shows bizarre, targeted price collapses on certain platforms, while the same assets stayed stable elsewhere. It was as if someone had chosen specific targets, leaving others untouched. This wasn't panic, it was a precision strike. The moves were calculated, deliberate, and devastatingly effective. The attack exploited specific vulnerabilities, turning the market's own mechanisms against itself. Automated trading bots and leveraged positions became weapons in the hands of the attacker. The result, a nightmare for investors, and a windfall for the attacker. In just a few hours, fortunes were lost, lessons were learned, and the crypto world was changed forever. How does a $19 billion liquidation start? Not with billions, but with a single $60 million sell order. On-chain analysts traced the crash to a targeted dump of USDE, a stablecoin, on one exchange. That small move triggered a chain reaction, amplified 322 times by the market's own leverage. The attacker knew exactly where to strike, at the base of a fragile tower of debt built by leveraged traders. The initial price drop set off forced liquidations, which triggered more selling, spiraling into a full-blown cascade. The market's automated systems did the rest, turning a modest action into a cataclysmic event. No need to crash the whole market, just a well-placed nudge. The result, a self-perpetuating cycle that wiped out billions. The attacker weaponized the system's own rules. The market did the dirty work for them. The real weapon? An oracle, a system that feeds price data into crypto platforms. If you trick the oracle, you trick the whole system. The attacker exploited a known weakness. A major exchange's oracle relied too much on its own spot price. During a scheduled upgrade, they dumped $60 million of USD, crashing its price on that exchange. The oracle broadcasted this fake price to lending protocols, triggering mass liquidations. Suddenly, loans using USDE as collateral looked under-collateralized, forcing automated sell-offs. No hacking required, just exploiting poor design and timing. The oracle, meant to be a source of truth, became the attacker's tool. This was a masterclass in manipulation. The system's transparency and fragility were turned against it. The evidence of manipulation is in the data. Certain assets crashed catastrophically, only on the targeted exchange. USD dropped to 65 cents there, but stayed stable elsewhere. WBETH plunged 89%. BNSol nosedived, again, only on the attacked platform. These weren't market corrections, they were targeted price assassinations. Arbitrage failed, either because the market was frozen or the attack was too fast. The attacker controlled the chaos, profiting from short bets placed in advance. The on-chain data shows a coordinated surgical strike for maximum profit. Blockchain transparency means the money trail is public. Analysts trace the attack's profits to a single wallet, allegedly linked to Garrett Jin, a former crypto executive. A $1.1 billion short position was opened just before the crash. No coincidence. As the market collapsed, this position ballooned, netting up to $1.2 billion in profit. The funds used for the initial attack came from wallets tied to Jin. Profits were quickly moved through complex transactions, but the blockchain doesn't forget. This points to a former insider exploiting the system for personal gain. The story is no longer abstract, it's about greed, betrayal, and accountability. The attacker lit the match, but centralized exchanges fueled the fire. As chaos hit, major platforms like Binance and Coinbase froze, locking users out. Investors couldn't access accounts or stop losses, forced to watch their savings vanish. Stop-loss orders failed, and some assets flash crashed to near zero on certain platforms. Binance faced harsh criticism for catastrophic outages and bizarre price drops. These failures reignited concerns about how exchanges operate and who really owns your assets. Experts warn, if your crypto is on an exchange, you don't truly own it. The infrastructure is fragile, and users are left dangerously exposed. Experts agree. This wasn't just unethical, it was illegal. The crash was a textbook case of market manipulation, a crime in any regulated market. Lawsuits and class actions are coming, targeting both the attacker and negligent exchanges. Thousands of traders have a strong case. They played a rigged game. Legal battles will focus on the attacker's manipulation, the exchange's flawed oracle, and platform outages. This event spotlights the urgent need for real regulation in crypto. Regulators now have a clear example of the harm from an unregulated market. The October crash may finally bring law and order to crypto. This fiasco exposes a hard truth. Crypto's dream of decentralization is being undermined by centralized middlemen. The very platforms that promised freedom from traditional finance have, ironically, recreated many of the same vulnerabilities. When we trust exchanges and custodians with our assets, we're handing over control and opening the door to the same risks we sought to escape. The October crash is a wake-up call. Centralized platforms can fail, freeze, and be manipulated. Billions can vanish in an instant, leaving everyday investors scrambling for answers. It's a stark reminder that the promise of crypto is only as strong as the weakest link in its infrastructure. The lesson is clear. If you don't hold your keys, you don't own your crypto. Ownership in the digital age means taking responsibility for your assets, not relying on someone else to safeguard your future. Self-custody is the only way to truly control your assets. By managing your own keys, you remove the single point of failure that has plagued so many investors. It's not just about security, it's about empowerment and independence. Move your funds to a personal wallet. Don't trust exchanges as vaults. Exchanges are convenient for trading, but they should never be mistaken for safe storage. Treat them as temporary tools, not permanent homes for your wealth. The industry must demand better infrastructure and accountability. We need transparent systems, robust security, and clear standards to protect users and restore trust. Oracles relying on a single data source are a security risk. Decentralized data feeds and regular audits are essential to prevent manipulation and ensure reliability. Exchanges must be stress-tested and held responsible for failures. Regular, transparent testing can reveal weaknesses before they become disasters, and accountability must be enforced at every level. Regulators need to protect consumers, not stifle innovation. Smart regulation can foster growth while shielding users from fraud and systemic risk. Investors must stay skeptical, understand risks, and take control. Education and vigilance are your best defenses in a rapidly evolving landscape. The promise of crypto is real, but it's threatened by greed and fragility. Only by learning from past mistakes can we build a more resilient future. Learn from this crash, move to self-custody, and treat exchanges as tools, not banks. Take proactive steps to secure your assets and encourage others to do the same. Your financial sovereignty depends on it. The future of crypto is in your hands. Choose wisely, act responsibly, and help shape a system worthy of its revolutionary promise.